Good afternoon, everybody. Thanks for joining us on today's webinar. Give us just a few minutes to get things started, allow people to kind of join the room, and we will get the webinar kicked off and moving. So let's just give everyone about another 60 seconds or so, and we should be able to get things rolling. All right, everybody, just another 30 seconds and we will get rolling. All right, guys. So, good afternoon. Thanks for joining us. My name is Tarek Moussa. I'm the host of today's event, if you will. And for those that are just joining us for the first time, obviously I'm with Disrupt Equity, and this is the Investor Power Hour, which is a monthly, basically educational series seminar that we put on for our investors and folks in the industry to just keep them abreast of the latest going on in the real estate space, the multifamily space, as well as ultimately teach them, educate them how to play in the world of real estate in general. So with that, today's Investor Power Hour covers some advanced strategies for effectively growing your real estate portfolio. So let's get things rolling. What we're going to cover today is going to be basically why you should build a real estate portfolio. We're going to cover some of the asset types in real estate and also more generally, some investment structures that you have options you can select from, and then also how to actually grow your portfolio, including the nuts and bolts associated with it. And then lastly, we'll talk about our next steps after you have all this information. So first and foremost, why should you want to build a real estate portfolio? For many of you, you've probably heard of real estate or are familiar with it, have some capacity, and have maybe dip your toes in it in some capacity even as well. The main reason that most people get into real estate, which are completely valid reasons and some of the strongest reasons for wanting to do so, is first and foremost financial freedom, right? At least getting you closer to that target of achieving financial freedom. Two is to build a good quality of life, right? When you have assets, obviously that helps you. And real estate is one of the quote unquote more passive opportunities in nature. So that is helpful too with regard to actually building a quality of life where you spend time with your family, your loved ones, and so on. And on the note of loved ones, another reason for building real estate wealth is a portfolio of real estate is so that you can build generational wealth for your loved ones and your next of kin. While you're here or when the time comes that we move on from this world as well. And then lastly is that with a big enough basically number in the bank account, you have the ability to be able to influence the direction of the world, of which real estate, of course, is one of the most powerful vehicles to helping you achieve that wealth figure. So let's talk about kind of some of the asset types in the real estate investment space. Most popular, most common, the thing that people have touched on in some capacity more frequent than others is going to be residential real estate. Real estate in general tends to be divided into residential, commercial. Residential tends to refer to single family homes, which is what many of us have either grown up with or in or around. Commercial, however, is really everything that touches real estate in a more business capacity, right? That can include multifamily, which refers to apartments, which some people get confused and think that that's actually a type of residential real estate, but that's not necessarily the case. It's actually commercial in nature, and that's how the lenders and the government, everybody looks at it as well. So there's multifamily properties, there's mobile homes, there's retail strip centers, industrial facilities, self-storage facilities, office buildings, RV parks. There's an endless list really of ways you can carve this. There's parking lots, parking garages, sports stadiums. It really goes on and on, but really anything that has a financial production kind of basis of real estate. And within each of these different asset types of real estate, they tend to be divided into several categories, of which at the, let's call it the luxury end of the spectrum, are what we call core and core plus, because they are core to a market and core to actually b- building a community around it of economic power. And then right below that, you have class A real estate, which is high quality, again, also good, but not quite necessarily brand new or the latest and greatest as what a core plus facility might be. Then there's B, which is a little dated, not terrible, but everything's still good quality, but just not necessarily the newest thing. Call it maybe 10 to 20 years old or so. And then, of course, you have class C, which is a little bit older, a little bit outdated, a little less kept up with, tends to be in a state of needing upgrades, needing to be modernized, and so on. And then there's technically also class D, but we don't really cover that just because that just means that it's in a state of disrepair and unlivable. And I'm sure we've all seen that either in person or in media, but that's kind of the way it's divided up in terms of what quality is the real estate that we're talking about. So with this, let's talk about some of the ways you can actually invest in real estate. First and foremost, the one that most people tend to start with is doing it yourself. What does that mean? You are the one who personally has to deal with all the day-to-day headaches, including dealing with tenants, termites, toilets, maintenance requests, and all the little things that come with actually investing in real estate or being a property owner. The second option, which is one that most people tend to graduate to, is to invest in syndications. And by investing in this, basically, you get to identify the property that you want to invest in before actually making that investment and funding your position. And the beauty of syndications too is that it's a little more passive, and as an investor, a limited partner in the deal, you also get to receive tax advantages of real estate similar to what you would have received by doing it yourself, but because a syndication tends to uh, basically be for larger commercial properties, then your number tends to be able to increase or be divided amongst other folks. The third option, which is one that's a little more accessible for folks, but not necessarily quite as attractive, is to invest in funds. And with a fund, you would be committing the capital that you wanted to invest into the investment before even knowing what property it's going to be deployed into. So it's kind of flipping the order of things compared to a syndication. And the challenge with funds too is that while they are usually more liquid and able to get in and out of, you don't necessarily receive the same tax advantages as you would for a syndication. And that doubly applies for if you're investing via a REIT on kind of the public listed exchanges. So with that, let's talk about how you can actually grow your real estate portfolio and the steps associated with it. Really, it's a six-part framework, and we're just going to go through them real quick here and dive into each one afterwards. So part one of the framework is going to be the acquisition phase, okay? Part two is performing the due diligence. Part three is going to be securing the financing and the funding. And by financing, I'm referring to debt, and funding, I'm referring to equity, okay? Basically, think of it like the down payment and then the loan. Then there's part four, which is to actually close on the property. Part five is to take over the property. And then part six is to begin actually managing the property and executing the business plan. So let's take a moment and actually dive into each one of these a little more detail. So part one is the acquisition phase that we talked about. This involves, first and foremost, generating property leads. And the way you do that is by doing marketing, and that can be both online and offline. You can do mailers, that's a popular one. You can run ads online or offline again. You can utilize wholesalers, leverage broker relationships, utilizing even the public listings on the MLS, right? There's a handful of other ways, but these are kind of the most popular ones that people utilize to actually find these deals and generate these property leads. The second step, once you've actually generated a lead, is to actually understand what that seller's needs and goals are. And the way to do that is by actually talking to them. Go figure. Then beyond that, once you actually have kind of situation, you know you've got an interested seller, then actually analyze the deal, right? Underwrite it, run the model, find out what the results are financially and whether or not there's a viable path here or at what number you would have to offer in order for the deal to be attractive, okay? And from that analysis, go ahead and actually determine what your offer price is that you can give. And like I said, that maximum allowable offer is what it's called whenever you determine what is the amount that you can pay for this to actually become a deal. Once you've got that figured out, then the last step in this part is to actually submit the offer and see what the seller says. Assuming that offer gets accepted, then you move into part two, which is performing the due diligence. In this part, there's really kind of two phases to it, which is first of all, You inspect the property using a local representative there, a local team who can actually go to the property and physically walk through it and inspect the entire property. In our case with multifamily, we walk through every single unit. Look through every single contract, look through every single area of the property to make sure that everything looks good, right? And like I said, this needs to be the physical walkthrough as well as visually through kind of all the important documents and leases and contracts to make sure that if you buy this property, what are you legally obligated to commit to, right? You don't necessarily get caught in the trap where you think that you're in the clear for something or you're committing to one thing, but in reality, you're actually on the hook for many other things that you were not expecting. And then once you've gone through that inspection and you have the information and you know what the truth is about the property and what you're going to be taking on, then you determine if you're actually going to need to make any adjustments to your offer. If you find that there's additional risk or additional sort of repairs that may be needed, then it may be appropriate to go ahead and adjust your offer price or the terms of the deal so that you can actually cover and make good on your intentions with the financial results by addressing the materially significant items that were covered in the inspection. And once you have that done, then part three is to actually move on to securing the financing and the funding to move forward with the purchase. So part one of this is going to be determining what the appropriate or comfortable leverage amount is that the deal can support, right? Most people love the idea of maximizing returns, and who doesn't love that concept? But the challenge is, of course, is that the higher leverage you take on the deal, the greater the risk that you actually introduce, because ultimately, when you're on the hook for something and you're paying a higher expense, which is a debt is ultimately an expense, then that squeezes the property's cash flows, which is what you would need to kind of weather any storms or ultimately pay back the investors or yourself as the investor. And that amount of leverage is called the loan to value or the LTV. Uh, then the second step of this phase is going to be to actually secure the loan for the deal. Once you determine what that leverage amount can be, then you move forward with actually securing that loan, and that could obviously come from a bank, which is what we're all tend to be familiar with, or in the commercial space, a bigger lender or consortium of lenders, or if you're looking to buy a smaller real estate property, then you may be able to get away with a private lender. Okay. And then the third and last step of this phase is to actually secure the funds for the down payment. Really, we call this equity, and this is basically to cover the down payment and what you would need to bring as cash to the table. And this may be money that you bring from your own pockets, or it could be money that you raise from a private lender or from investors. So in our case, whenever we do a syndication for a larger multifamily property, we may buy a $30 million property, and let's just say we take $20 million that we get as a loan from the bank, and then we have to bring $10 million of cash to the table. And that is what we would need to actually fund up front before the lender release their portion, and that will allow us to actually move forward and close on the property, which is the next part of this. So last part is to actually close on the property, and that means once you've gotten all the financing in place and everything looks good and everything checks out, then you move on to legally transfer the property into your name. The way to do that is to, number one, sign the closing docs, whether it be in person or remotely. Two, actually wire the funds to the title company so that we can have the exchange of ownership and funds as agreed upon. And then third is to wait for the official announcement that the title for the deal has officially closed and transferred. Okay. And that comes from the title company who's kind of facilitating the transfer. And then once you've done that, go ahead and celebrate because you just achieved a major milestone. But don't necessarily get too crazy because the work is not done. Because the next part is to actually take over the property. This is where the real work begins. Everything you've done to date is a process that required a lot of work and it's an achievement, but it's all theoretical still. Everything that you just executed and got to this point was the analysis you performed with the expectations for what you think is going to happen. But now it's time to actually put the theory to reality and hopefully make it come to fruition. So the way that is to take over the property, which means bringing in your own management company. If you're buying a small property, some people like to do it themselves. We always encourage using a management company so you can scale properly. And when you bring in a management company, that involves deploying your staff as the boots on the ground at the property, putting in place your software, and deploying your systems and processes. And then once you've had that, somebody internally on your team as the sponsor of the deal, you would assign an asset manager from your team to basically oversee that deal. And for those who don't know, there's levels to this. You basically have the property management company who is the representatives, a team of folks that are physically at the property in the leasing office doing all the day-to-day work. But then you have the asset manager who works for, let's call it the sponsor above the property management company, and they're the ones who basically direct the property management company and tell them kind of what to do, what targets to hit, what does the future plans look like, so that they can all stay in sync and everybody knows how to move forward on a day-to-day basis. Okay. And then the last step is to actually start doing the execution of the work and managing the property and executing the business plan. And this involves really three main people. There's the management company that I alluded to, there's the asset manager, and then there's the sponsor. So the duties for the property management company include taking care of maintenance requests that come from tenants on a day-to-day basis, turning over and renovating units where appropriate. If this is going to involve some sort of value add project plan where you might be improving a property from, call it, Formica wood countertop, something, to an elevated quality of, say, quartz or granite, which then would allow you to increase the rent and give a higher quality of living to the tenants. And then once you actually have those units renovated and turned over, then you lease the units to tenants, and of course each month collect the rent, and manage the budgets as you go through the capex and the renovations to make sure that you don't exceed budgets and that the numbers are going to work out and make sense. The asset manager's duties in all this is to actually create and oversee the budgets and make sure that the business plan is being executed properly. And their job is to basically track and measure the results that the property management company is doing against the business plan constantly and keeping them on track with the project and making sure they're not deviating too much or things are not falling off by the wayside. And their role is to really provide feedback and assistance to the management company on a regular basis and ultimately be kind of a liaison between both groups and helping both between each other as needed. And the sponsor's duty as this of all in all this, of course, is to one, bring the capital to the table, the equity, put the whole deal together, and then thereafter start to hopefully generate an income from the property from the execution of the business plan. And once they've started collecting that income, to actually pay out distributions to the investors, which is what they invested in the first place for, right? They want to return on their investment, and the sponsor is to the goal is to basically produce that and facilitate the issuance of the distributions to the investors. And once you've done all this, the results of it is that you now know everything that you need to know to grow your portfolio. And this is exactly what we did here at District Equity to grow our property, really our company portfolio to now over 7,000 units, and in the management side, even more than 10,000 units. And it all sounds pretty straightforward, I know. And the reality is that it is, because the process in real estate, it's not like some other investment opportunities or investment classes where it's super complicated and super crazy. The reality is that real estate is fairly simple in nature, but it's not easy, right? It's always easier said than done, but in theory, the process is relatively simple and straightforward, but it requires work. So if you've seen all this and you think that, man, I would love to invest in real estate or in the commercial side or scale this in some meaningful way, but it's just a lot of work. Maybe I have another day job, maybe I have other obligations, maybe I got a family that I want to take care of, and I don't want to do this, then what can you do? Our recommendation is to, in that case, go ahead and invest passively as a passive investor in some other deals. And that would be with a syndicator, someone like ourselves here at Disrupt Equity. There are other folks out there too, but I can only speak to us and kind of give you kind of what we would do and how we would go about it. And realistically, that sponsor would be the one to handle the day-to-day operations and nuances of the project and the deal. And that is what we recommend, and make sure that they actually have a track record of success. Obviously, you can see our stats here on the screen. I'm not going to walk through them right now, but you can obviously see for yourself what it is. But if you wanted to go on this path and maybe work with us or work with other folks that you want us to refer you to, let us know, right? We encourage you to reach out to us and check out our website at disruptequity.com/invest. If you go there, you can sign up to receive our information and get the latest and greatest about our investment opportunities. We've got 2 currently, we've got more coming in the future. We've got some pretty cool things going on right now, and I know that it's a tougher time in the market, but the reality is that we are seeing some incredible deals come across our desk, and the herd of competition has really thinned out over the past couple, call it 2 years or so, and we're seeing a lot of distress opportunities come our way that we are able to scoop up for really interesting prices that make the deal super attractive. So if you want to learn more about that, go to disruptequity.com/invest and sign up there where you can basically receive opportunities as they come along. And if you ever have any questions or want to get in touch with us, then reach out to us at invest@disruptequity.com, and we'll be happy to schedule a call to speak with our team and make sure you get all of your questions answered and learn more about kind of who we are, what we do, and how we can potentially help you achieve your financial goals. So hope that was helpful, everybody. If you have any questions, please send them over via email. And from here, we will send you future emails regarding the next Investor Power Hour next month. And look forward to seeing you with us at that time. Keep an eye out for emails, and you will get all the information there. All right. Thanks a lot. Have a great day.